Good day, subscribers. Thank you so much for joining me today. I am Jeremy. This is the Financial Education Channel, and today we're talking about why I invest the way I do. Why is my investing process the one I choose? Why do I think this is the best type of investing process? I'm going to kind of give you guys my whole argument today on why I believe my investing process is the absolute best out there without question, and why I 100% believe in it. Now, with that being said, just because I feel my process is the best way of doing it doesn't necessarily mean I think others that are doing a different way is bad. I'm all for it. Like, if you want to be a day trader, fine. If you want to be a short-term trader, a swing trader, if you want to be a super long-term investor, like, I'm all cool with that. I think it's just badass that people actually give a shit enough to like make their money into money at the end of the day. Like making, like, first off, to even invest, right? You got to have money. You got to be doing well enough personal finance wise to even have enough money to then go ahead and invest. So I think the fact that you're at that point, that's phenomenal. And I think the fact that you're trying to make that money into money is great. And even if you pick a strategy that you fail, let's say, well, sooner or later you're going to figure it out. Like, that way doesn't work, let me try this way, and then this way works, and you do good from there on. So even though I feel like my way is the best way, anybody that has any type of investing style, real estate, commodities, gold, whatever, I'm like, that's cool. Like, I'm fine with that. You know what I mean? Not everybody has to do my style, and thank goodness not everybody does my style, because if everybody did do my style, then every company I ever want to invest in would have ridiculous valuations. So, you know, it's good that everybody's got their different way of doing things. But so, usually I prepare, like, you know, my iPad here, and I have like points laid out so I can kind of keep on track. I didn't want to do that for this video. I just wanted to be one of those videos that's like, if somebody just asked me, like, why do you invest the way you do? So my way is called modern long-term investing. It's a term that I literally created. It's, you know, I call it even on the book, modern long-term stock market investing. No one's ever coined that term. It's just something I completely made up out of thin air. It's an investing style that has definitely some Graham, Warren Buffett type principles in it, but it definitely has some other people in it, and it definitely has my own little flair into it. So what I'm kind of looking at as far as what I look for in a company and how far out I'm looking. So I'm looking for I'm looking for a minimum of 1 year out to more like 3, 4, 5 years out. What do I see? What can I foresee with that company? So one is, sometimes some people will say, an argument for me is like, sometimes people will say, Jeremy, why do you look 3, 4, 5 years out, 2 years out even? How do you know what's going to happen in the future? And the truth is, you never know 100% sure what's going to happen in the future, but that's part of investing. Like, it don't matter what investment you pick out there, you don't know what could come. So it doesn't matter what level you're investing at. There's not one stock out there that you can definitively tell me 100% that this stock will be doing this well, you know, 5 years from now, 10 years from now. There's not even one stock. Being an investor is a lot of being in a business, man, at the end of the day. You need to make business decisions based upon where you see a management's decision making going over the long term. And one of the important things to hear is what management is looking for over the long term, and then making a business decision to then invest in that company. So that's kind of the way I'm viewing things, and the reason I kind of look for that, you know, 3, 4, 5 years out is because that's what I can realistically see. I can't see past 5 years. Like, people ask me, you know, 5, 10 years from now, what's this company going to be doing? I don't know. That's too far out. It's too far out nowadays, and that's kind of what differs me from the Warren Buffett type, Ben Graham type investing philosophy, which is buy and hold forever, because things change too fast nowadays. We're so advanced nowadays. You know, 2017, things change so fast that you can't realistically see 10 years out. 10 years from now, will Walmart be making the money they're making now? I don't think so. Like, I would highly doubt it. But who knows? Maybe they will be. Maybe they'll, you know, take packages really seriously, you know, and delivery and the internet and all this stuff. And maybe all of a sudden they'll knock off Amazon. But right now, I would say, heck no. So I can't see out that far. I can see out 3, 4, 5 years. I can see the vision. And if I don't see the vision with that company over the next 3, 4, 5 years, then I don't invest in it. It's got to be a company that at least 1 year out plus, I'm seeing good things with them, developments and those kinds of things, guys. So that's kind of my thing. And what do? I look for a company that's got a great balance sheet. Now, why do I care about a balance sheet? Well, because I'm planning on investing in that stock for the next few years. Doesn't always mean I'll be in that stock for the next few years. Sometimes, say it goes up a ton. Maybe I'm just like, got a better place for my money, I might sell out. It doesn't, just because I buy a stock, it doesn't mean I'm going to absolutely hold it 1 year to 5 years from now. It really doesn't. It really doesn't. There's been tons of stocks that I put money into, a little bit or a lot, and it just suddenly spikes a ton, and then I just sell out, take my profit because there's something better else I can go into. But balance sheet. Why do I love a good balance sheet? Specifically cash heavy and investment heavy, low in debt. Well, because I'm planning on being in that stock for the next few years. Let's say a rough situation happens with that company, a lot of mistakes. I'm not going to be able to sleep well at night if that company has a poor balance sheet, guys. I'm not. And you can say, well, yeah, you could just sell it off at that point. Well, yeah, you're probably going to be down massive amounts of money already at that point. So my thing is, if I'm holding a stock for the next 3, 4, 5 years, I want a stock that is going to let me sleep well at night, even if management screws up. A great one there's been tons of stocks since I've started that, it made sense to have a great balance sheet company, but one in particular was GoPro, right? GoPro, one of the things I saw in GoPro was a phenomenal balance sheet. And so I said, okay, if this company screws up, something goes wrong, then they can get through it and they won't go bankrupt. Well, guess what happened? I don't want to say that word. GoPro screwed up so many things, right? And they went so unprofitable because they messed up. They had it's just, I've said the story a million times. They had so many screw ups. Well, thank goodness there's still a company there at the end of the day, because if they had a bad balance sheet, I'd invested in that stock, and then they made those mistakes, they would be probably bankrupt right now. They would probably be out of business. The great balance sheet has gotten them through this whole situation, and then hopefully, the job cuts and all those kinds of things. But that is why balance sheet is key, because guess what? Someday you're going to pick a stock, you're going to pick a company that things are going to go wrong. And that's happened to me with that stock in particular. And it's not the only stock in my career that's happened. It's been other stocks, but at some point, something like that's going to happen. And you're either going to lose all your money, or you can, bounce back and those kinds of things, guys. So that's big. And when I'm looking at a company, I need to see the vision for the products or services that company sells over the next few years. I'm looking and I'm saying, is that product or service going to expand, decelerate, or keep about the same? And these are not quantifiable type things, right? It's really me judging as a businessman what the vision is there. So, it's not like you can say, there's just some metric you can do, some financial metric. There's not some financial metric that can tell me iPhone's going to be selling just as many units or more units 3 years from now. There's not. But me making as a businessman, I see Apple there, and I say, in my opinion, Apple, 3 years from now, Apple will be selling just as many iPhones, if not more, 3 years from now than they are this year, right? So that's me as a businessman making a business decision. It's not like some quantifiable type, let's run a metric, let's run a number type thing. So I got to see a vision for the products, got to see a vision for the services. I got to see that there's going to be some type of expansion. I don't like management teams that get content. I don't like management teams that just get content and they just don't want to explore something new, because guess what? If you have a major competitor that comes in your space, where you get the majority of your revenue from, the majority of your, revenue and profits from, if you have a major competitor come in there and they take some market share from you and you don't have something else brewing, guess what's going to happen? Your earnings are going to go down, your revenue is going to go down, and what's going to probably follow? Your stock price is going to follow, which, in my investing philosophy, what do I do when a stock goes down? When I invest in a stock, there's a 50-50 chance that from my initial investment, that stock's going to go down or up in the short term. 50-50 chance. Now, if it's a bull market, there's a better chance it'll go up. If it's a bear market, better chance it will go down. So what's my philosophy on if a stock goes down? Well, basically, if for every, let's say 5%, 3 to 5% it goes down, I add more shares. And it is never like a specific amount. It's not like, oh, let me double my position. Oh, let me add 50% more, let me 20. It just depends on the situation, how much money I have available. Do I want to go any heavier into that stock? Things like that, guys. So I'm looking at it and I'm saying, okay, this stock I just invested in, I loved it at, $50 where I just bought it. Now it just went down to 46, basically for no reason. The fundamental company, I still like it just as much. Well, what the hell? I'm going to buy it at $46 now. I'm going to stick some more money in there because you know what? If I believe in it just as much and it went down, then that's just a better price for me to get in at that point, right? Now, if something changed with the company and all of a sudden I don't like the company, then maybe I won't buy and I'll sell it. But at the same time, the way I do research, the way I research in a company, like I'm 100% sure on that company when I go in. Doesn't mean it's going to go 100% up in the short term, but over the long term, I'm like 100% confident that I'm making that right decision. So the chances that I would just invest in a company 3-6 months later and then sell it down, it's almost a 0% chance, literally, guys. I can't even think of a stock I've ever done that on. Literally, in 9 years of investing, I can't think of a stock I've ever invested in. It went down and then I sold it, except for, the only exception is 2015, the year I lost $75,000 doing trades and whatnot. And you probably know that story. You probably watched the video I have, and it's one of the most popular videos on the channel where I was trying to trade and all those kinds of things. And let's talk about that real quick. Let's talk about why I don't trade. Let's talk about why, we already talked about why I'm not a super long-term investor like Buffett, because you can't realistically see out that far, in my opinion. Why am I not a trader or a short-term trader? Well, first off, I tried to be a short-term trader. I failed. I lost $75,000. I don't know how else to say it other than that. I failed at being a short-term trader. Why don't I be a day trader or try short-term trading again or something like that? Well, basically, I don't see any vision for short-term trading. First off, my investing strategy is what took me from 0 to 200K. That's what did it. My modern long-term investing strategy, that's what took me that number. And you know what lost me $75,000 in 2015? Me trying to trade. So it doesn't mean I can never try it again, or I have no plans to ever try it again, so I shouldn't even BS around that. But why am I not a day trader or something like that? Well, day trading is an interesting thing. First off, I know no one ever, and I know a lot of people that have tried, I know no one ever in my personal life, out of friends and family, who've ever succeeded as a day trader over the long term. I know some that, started and they had some beginner's luck and, did well, and then they lost massive amounts of money. No one ever that's ever done that. Every single person I've ever taught my investing philosophy over to them over the coming years, they've all made money. And I know 0 people ever that have made money, despite knowing a ton of people who have tried day trading. I know no one ever who succeeded. So it doesn't mean you can't succeed. Maybe you can. Maybe you have the right philosophy of those kinds of things. But I'm not going to try it because there's no philosophy I've seen out there, and I've looked at a ton of them that I'm like, that's the one. I should do that or something like that. There's nothing. In my opinion, it's a lot like gambling. And what you have in the day trader community in whole, and I don't want to sound like I'm hating on the day trader community, because I'm not. And once again, if that's the way you want to be, that's the way you want to be. I'm just looking at it from my point of view, and I'm sharing my point of view. And if you can't respect my point of view, then that's fine. You can turn it off now. In my opinion, what you have in the day trader community, you got a lot of people who are trying to sell stuff. And you see it here on YouTube a lot of times. Take my $1,000 course, take this course, and trying to sell a lifestyle. And why do they need to feel like they need to sell a lifestyle? You notice a lot of these traders will try to sell a lifestyle, and oh, look, I'm living in this house. Oh, look at my Lamborghini. Oh, look at my Ferrari. They're like trying to show a lifestyle. And I feel like they're trying to get a lot of weaker minds in the day trading community. A lot of people that just see that stuff and get real excited, like, woo, let me get a Lamborghini, and it really doesn't work out. And what you have is a lot of people that are basically make their money not from day trading. They make their money actually from selling their $1,000 course, their $100 course, their $10,000 course, or things like that. That's how they actually make their money. And what you also have is you have a lot of professional day traders who act like they're professional day traders, and really they're not, but they can show a lavish lifestyle, not because they made their money day trading, but because honestly, they made their money some other kind of way. And day traders and poker players sometimes are a lot alike in this respect, where you got a lot of poker players. I live here in Vegas, right? You got a lot of professional poker players that hide behind that identity. Oh, I'm a professional poker player. Look at my fancy car and this and that. And then you do a little more research in them, and you found out, oh, they actually made their money because they sold this tech company for 15 million a couple years ago. That's how they got their money. But they're a professional poker player. They're a professional day trader. Really, they inherited a bunch of money from their parents. They were a trust fund baby, and they had the golden spoon in their mouth. And now they hide behind an identity of day trading or doing this or doing that. And it's like, then you really look into things, and it's like they're not actually making money. They're not even good at poker. They just think they're good at poker, and they try to, put on this persona. Oh yeah, I'm a professional day trader, I'm a professional poker player. You see that a lot, guys. So I can't get behind something that I've never seen anybody in my life ever succeed at. And why would I go against a thing that built me and the thing that I've seen everybody else make money with? So why would I do anything other than what I do, guys? Now, why do I care about trying to have companies that have lower type PE ratios? Well, a PE ratio is basically a metric to see how highly valued the company is or lower value. So I like a lower PE because that means the company basically has enough net income to pay off to its shareholders in a shorter amount of time. The higher the PE, the more overvalued technically the company is. But of course, if the company has phenomenal growth, then I might look past the PE a little bit. So let's say a company's growing revenues by 50% right now. They're growing net income by 60% a year right now, but they have a 33 PE. Well, if I see that company being able to keep up that growth rate for the next 3, 4, 5 years, or something close to that growth rate, a 35 PE, not that high, because you do the math on what that net income is going to add up to, and guess what? That PE ratio in 3 years from now, that's going to be super, super, super low unless the stock rises, which the stock has to rise to give the valuation a realistic expectation. Why don't I care about dividends? Why am I just kind of, why do I not care about dividends? When I was a beginner in the stock market, I absolutely cared about dividends. When my first couple years, I wouldn't invest really in anything that didn't pay dividends. Why did I kind of move away from dividends? Well, dividend companies, generally speaking, they pay dividends mainly because they don't have as much growth going for them. So they don't have as much growth, and my style is I'm looking a lot to the value side, the Warren Buffett type Ben Graham. I'm looking value, right? But I'm also want a company with growth. I want a company with a lot of growth, preferably, a company that's growing 15, 20, 30% type revenue numbers, net income numbers, those kinds of things. Those are the type of companies I really like. And those type of companies generally don't pay dividends because they're using their money to reinvest back into the business, because that's their best way of hiring more employees so they can expand these products and services. A company that's paying dividends, they're basically saying, we got too much money that we don't even know what to do with, so we're just going to pay it back out to the shareholders. And when they pay that money back out to shareholders, then the stock basically becomes less valuable. Because here's the thing, let's say a company has $1 billion valuation, right? But let's say they pay out $100 million in a dividend that year. Well, now their balance sheet has $100 million less in cash on that balance sheet, and that money's gone. It's gone to the shareholders already. So now that balance sheet has $100 million less in that balance sheet, right? That can be used for that rainy day we talked about. You'd be used for hiring more employees, be used for this or that. So dividends are good if it's a company that's so built out that the growth really isn't there to justify the money, or they just have so much freaking money coming through the door that they don't know what to do with. Apple comes to mind, Google comes to mind, Facebook in 2 or 3 years comes to mind. They're going to have way too much money coming in the door they're not going to know what to do with, so they might as well start paying dividends. So there's definitely companies, and that's definitely fine. You can be just a dividend investor. That's just not my personal way of doing it. However, I'm 27 years old. I got 2 businesses. I have a different philosophy. Now, when I'm 47, 57 years old, dividends will be more important to me because I'll be looking for more safety. And a lot of times, the dividend-paying companies are technically safer. They have big competitive moats around them. They're huge corporations. It's hard to knock some of these guys off and gals off. So technically, they're a little more safer than some of the other guys that can be volatile and can go down 40, 50% or whatever. So as I get older, dividends become more important, and the growth, the extreme growth that I'm looking for, it's not as important after that, guys. So I tried to explain kind of my investing philosophy. I hope I did. This is kind of like a sloppy video because I don't have my iPad here, and usually I have like points laid out. I just wanted to just talk and kind of get my points across there. Whatever type of investing style you have, cool. I'm cool with it. You know what I mean? I just am happy that people actually care and give a shit to like invest. That's freaking awesome, guys. So anyways, if you just came across this channel, you may want to subscribe. We talk personal finance on the channel. We talk entrepreneurship. I'm an actual business owner. I give away so many business tips. We talk the stock market more than anything. Thank you for watching, guys, and have a great day.